and we've got a fantastic lesson for all of you today, especially if you own gold and silver. One of the first things that we talked about when we started EVG in December of 2010 was the importance of owning precious metals these days, thanks to government policies and quantitative easing. Gold and silver have both hit record highs recently, and we think that, at least I think, they've got many hundreds of percentages more to go over the next coming years. So today I've brought on Tom, who is my CPA and one of the contributors here at the Elevation Group, to share his insights and expertise with all of us on really step number 2 in the process, which is the most important one. When it's time to sell your gold and silver, what are your options and what are the tax ramifications? So for me, in the past, we've talked about the fact that I want to take my gold and silver, sell it, as close to the peak of the gold and silver bubble as I possibly can. For me, my expectations are gold anywhere from $10,000 to $20,000 an ounce, silver anywhere from $300 to $3,000 an ounce, and we'll talk about that obviously more when that time comes. But today is the time to start planning on what you're going to do when you sell it, because the window is going to be very short. I expect that it will be only days or weeks, maybe a month top, a month at the most, to get the maximum value extracted from that metal and to put it into different cash flow assets. So, Tom, are you with us?
I'm here.
Awesome. Fantastic. So this is essentially like a strategy session that you and I have talked about before. Wanted to have you share your expertise and insights with the rest of the membership here. And we have a lot of EVG members who own precious metals with the expectation that obviously the price is going to go up. And when the time is right, we will exchange those metals in and cash those in for cash flow assets such as real estate, apartment complexes, maybe oil wells, natural gas. There's all different types of things that we can trade the metals in for, but what are the avenues? What does that look like from a tax perspective? Do we have to cash them in for dollars first? Can we trade them can I trade a box of silver for a house? All of these questions that members have, and so I want to go ahead and have that conversation today. Hear it from you as the tax expert here on the team, and let's start laying out some options for people.
Yeah, absolutely, and I'm glad we're having this conversation now, because there are some things that we can do early on, but later on we can't do in preparation for this. So maybe we should start with just kind of what the general rules are, and then we go into what the options are. The general rules. I'm sorry. I was
going to say, and let's also keep in mind the different ways to hold gold and silver. A lot of people have the physical coins. A lot of people have numismatics. So let's talk about collectibles and put those in there. And let's consider also a potential windfall tax. That has been heard through the grapevine here. If metals were to skyrocket, that Obama would come out with a 90-80% windfall tax and kind of take away the winnings from everybody who was on the right side of the wealth transfer. But anyway, keeping that in mind, the floor is all yours.
All right, great, thanks. So here's the general rule or the law as it stands right now. Gold and silver are treated as an asset, if you will. They're not treated as money, and it doesn't matter if they're coins or bullion or they can be gold eagles. It doesn't matter. They're not treated as money, which I've heard some commentators say that they should, that you should be able to. Okay, if you've got a $1 gold piece and you go buy, a house with a $1 gold piece, then there should be no tax on that when you make that trade. The answer is right now the courts have been very clear. That's not the case. So when you trade or use gold or silver, whether it's a numismatic coin or no matter what it is, and you trade it for some other asset, okay, unless it's exact. So you always trade gold for gold because gold is fungible, okay, so that's okay. But even if you were to trade one numismatics coin for another, that's a taxable transaction, okay. unless they were exact. And then you could probably, I think you could probably do what's kind of like-kind exchange. But like-kind exchange generally is not going to work with gold and silver. I mean, you can trade bullion for bullion, that's fine, but why you would do that, I'm not quite sure. But you could probably trade bullion for Krugerrands, for example, and that would probably work. But you could never trade, gold for a house, and there's no way to do that. Plus, if you own paper, if your gold is basically a paper asset that you want to write to gold or something like that, it's very possible you can't even do gold for gold because the like-kind exchange rules, which we think about a lot when it comes to real estate, where we can trade one piece of rental real estate for another, regardless of what it of the quality of the real estate, that doesn't apply in paper assets at all. Okay, so you can't trade a share of IBM for a share of Apple. That doesn't qualify for a like-kind exchange. Okay, that actually there was a time when it did, but it doesn't anymore, and it hasn't for many, many years. So the general rule now is if you do a trade for anything, basically, other than itself, the gold itself, you're going to have a gain, and if you've held the gold or the silver, the metal, for more than a year, then that gain is going to be a long-term capital gain subject to the precious metals capital gains rate, which the precious metals capital gain rate right now is 28%. So it is a special rate. In other words, and what that means, when it's a 28%, if you're in a lower than 28% tax bracket, you're going to be taxed at the lower bracket. The 28% is the maximum tax bracket, not a minimum. It's a maximum.
Now what if
you're in a 35% tax bracket, then you're going to be at 28%. If you're in 25% tax bracket, you're going to be at 25%.
Now what if you bought within the last 12 months? What if you bought 6 months ago?
Then it's just ordinary. It's actually short-term capital gain, which is taxed at ordinary income rate. So there's no special rate on that.
Okay.
So that's whatever your ordinary tax rate is.
Okay.
There's some benefit that it's capital gain because you can offset capital gains by capital losses, and a lot of people are basically trading in their stocks at a loss for gold, which will produce a gain, and those capital losses are carrying over. So those capital losses can offset the capital gain, all right? So, you do have some benefit that it's considered a capital gain. It's just that the capital gains rate is not the 15% that we see for other things. It's a special rate of 28%. So that's your fundamental rule right now, Mike.
Okay, great.
All right. So then the next question is, well, what could you do now to help your tax consequences later? And my favorite, I'm not, as Mike, I know you're not. I'm not a big fan of IRAs as a general principle, just because they're so highly regulated and we can't get leverage, and there's all sorts of other things that make IRAs bad. However, especially a Roth IRA, when it comes to holding gold and silver, I'm a huge fan of holding gold and silver in a Roth IRA. And the reason is that a Roth IRA is not taxable at all. So in other words, you're not getting the deduction when you put the money into the Roth IRA. When you take what happens then is when you take the money out of the IRA, it's not subject to tax. Now, there are certain rules as to when you can take it out, but the general rule is no tax when you take it out. So if you have gold that you bought at $300 an ounce, and it goes to $20,000 an ounce within your Roth IRA, it's non-taxable. That's the general rule. And it's not postponed tax, it's never taxed. So I love owning, this is the one investment, actually the investment I like best in a Roth IRA is gold and silver. And now, it has to be bullion, or it cannot be collectibles, okay? So you cannot put collectible coins into an IRA, Roth or regular.
Now, in order to do this, you would want to implement the strategies that we've gone over here in EVG on essentially freeing your IRA, correct, so that you can take control of the checkbook?
Absolutely. This needs to be a self-directed IRA.
Yeah.
If you've got a 401k and you're no longer working for the company, you can roll that 401k into a self-directed IRA. If you've got a regular IRA, this may be the time that you take that regular IRA and convert it to a Roth IRA. Now, anybody, regardless of income level now, this is a new law in the last couple of years, can convert a regular IRA to a Roth IRA, the cost of conversion is the tax as if you had distributed the regular IRA. There's no penalty, but you do have to pay the tax. So, for example, if you have $10,000 in a regular IRA and you convert it to a Roth IRA, then you're going to pay tax on $10,000 of income when you convert it. The reason you'd want to do that, of course, is that if gold's at $1,700 an ounce and it's going to and you think it's going to $20,000, better to pay the tax now than when it's $20,000 an ounce. And if you leave it in the regular IRA and you let it go to $20,000 an ounce, yes, you won't pay tax now, but down the road you're going to pay tax at the highest income tax rates on that $20,000 an ounce.
Now, how would, I'm trying to think of, well, a couple of questions come to mind. Real quick, any additional information or pieces of info needed here if we're talking about, instead of physical bullion, if we're talking about stocks?
No, you can do the same thing with stocks, okay? Now, stocks don't have the, it really depends on what you really own, okay? When you own, I mean, if you own a stock in a gold mine, for example, you don't own any gold.
Right.
Okay, but if you have paper that represents gold, you might actually own gold. So we'd have to actually look at that on a case-by-case basis. But the general rule is stocks. So let's say you have stock in a gold mine. That is going to be taxed at 15%.
Right.
So
okay.
That qualifies for the regular capital gains rate. That's because it's not actual. You don't actually own the gold or the silver.
Gotcha. Right. Okay. So that's important to know. Roughly 13% tax savings right there.
Right.
And this is no one knows the answer to this, so we can only really play devil's advocate. But let's say Obama or whoever's president at the time wants to do the windfall tax. Let's say it's 90% on gains made from gold and silver. Do you feel that would be on physical bullion only? Do you feel that would also apply over? Do you think they would make it apply to stocks as well? And I know you don't know the answer. No one can have the answer to this. We just have to make our best guess. But
well, and I can give you some insight just because when you know tax policy history, it's easier to predict the future, right?
Right.
I would be shocked if they were to tax bullion, if they were to tax stocks.
Yeah.
At that higher rate. And now they might, Obama talked last night in his State of the Union address about putting an extra 15% minimum tax on people making more than $1 million anyway. Well, if gold is $20,000 an ounce, you're going to be in the millionaire tax. You're going to have that minimum tax. Okay, so you're not going to be at 15% anyway. You're going to be at 30% if that law were to pass.
Okay.
So stocks now. I really would be shocked if they you say this kind of a stock. I think we'd have maybe even some constitutional issues if they say this kind of a stock it gets taxed differently than IBM stock.
Right.
The bullion's pretty easy. That's easy to distinguish because we'll just say, okay, we're going to put this excise tax is what it would probably be, an excise tax on the sale of gold or silver. Now, here's another reason to have it in an IRA because I would be shocked if they did that inside the IRAs. Yeah. So if you had it in the Roth IRA, unless the way they did it, they could do it. The way they would do it is make it an excise tax, which is a transaction tax, not an income tax, and so it would be a tax on the actual sale of the gold, and then it wouldn't matter how you owned it.
Yeah, I see the whole IRA thing as a great way for the middle class to get revenge.
Yes.
Kind of like here's how to turn your sour grapes that the government's handed you and into a win, which I think is fantastic, and that everybody should do. And I think that's going to be probably the most valuable piece of this phone call for the vast majority of people listening. For my personal circumstances and for the others who are in the same boat as me. The IRA is great. One, I don't have one, And the other problem with it is the maximum